Coming off its worst two-week stretch since the start of the virus pandemic. This is the tech bounce back that has been all important to the last decade and a half of a market narrative. Anytime there is any kind of a bounce, it is in many of these technology names or technology adjacent names that are now massive in terms of overall volume. Jason Snipe, I turn to you for this because many of these stocks are ones that you would own or that you do own in the portfolio right now. I'm talking about the Apple, Microsoft, Alphabet, Amazon, Tesla, Meta type situation. Are these now levels where they become attractive again?
Yeah, so what I would say about tech, I mean, tech has been a great story over the last decade. I mean, rates have been very low. It's been a tremendous environment for tech stocks to run. And obviously with the regime shift, this tightening cycle that we're all going through, a lot of these names have pulled back. But to your point, Dom, I mean, the multiples have come in some. I do think there's still some more pain there, unfortunately, because as I mentioned earlier, I think the Fed is very much engaged and they'll continue to do what they need to do from their perspective to stymie demand and continue to slow the economy. So if you're looking at long duration assets that are relying on the credit markets to grow, I mean, those are the names that will continue to get hurt. But on the mega cap tech side, I still like Apple, I still like Amazon, I still like a lot of these names because of just from the growth prospects, and it's all about innovation going forward in my view. So not to say that I'm jumping in these names right now, but I still think, going forward over the next couple months, they'll present some even better opportunities than there are right now to jump in or potentially nibble.
So, Jim, you had brought up previously this idea of growth versus value, this kind of movement between them, the rotation, if you will. There's no doubt that in 2022, growth has very much underperformed what's happened with value. Although I would point out in the last couple of months, we've seen a little bit of that kind of reverse course, meaning people have taken some of the money away from the value-oriented names like in energy or materials and elsewhere, and then have started to start putting maybe money to work on the growth side, and that could be names like Alphabet or Amazon or Apple. Is this the beginning of something bigger, or is this just something where you see it's a noise piece in this whole market narrative and value continues to outperform?
No, I think it's serious, and I think the noise is 1 month of one style outperforming the other. If you just go back historically, these growth versus value shifts in leadership last for a decade. Right, the 90s were all about growth. In the aughts, growth was left, dead on the road. Amazon, Microsoft, these things were left for dead. And there's things like banks, energy that did really well. And then again, that reversed in the 2010s. Now we are here in the 2020s, and I think we're in the early stages of the transition. It's in part because of the relative differentials between the multiples. It's also now, though, we're in a behavioral part of the transition where when people want to tiptoe back into the markets, when they think maybe the bottom's in, where do they go? They go to the tried and true favorites of the last decade, the Apples and Microsofts and Amazons of the world. Now, what are they saying? They're saying, listen, I can't get too beat up in these. These are the stalwarts. These are the things that were defensive in the last decade. They've never really been defensive. What they've had is good growth that promoted a multiple expansion that made them seem like they just were a no-lose scenario. Now you cannot get multiple expansion from these anymore. If you take a look at Apple, just as an example, 23 times next year's earnings, I don't think that multiple is going to expand. However, its earnings per share growth will be 12%. That's what analysts say for the next several years. So think about Apple now at, I think it's 150. And if you had 12% gain on it from here until the next year, that would put it in the 160 to 170 range. That'd be fine, but I don't think that's what people are going for. On the other hand, if you look at energy, which obviously has come down recently, there's a long-term structural imbalance between supply and demand that can generate much higher earnings per share growth and along with it multiple expansion for these stocks. This is the transition I'm talking about. People need to come to grips with the fact that you're not going to get multiple expansion in what led you into this bear market. You will get multiple expansion from those things that have been underperforming for years, but whose earnings per shares are now growing much better than the market overall.
Jim, I'm glad you brought up the earnings story as well as Bryn. You guys both brought it up. We're going to address that just a little bit later on in the show because the expectations could change, especially for technology.